If you drop a few dollars into a piggy bank every day, the math stays small and predictable. By the end of the year, you have exactly $360. The problem is that the $360 buys less today than it did a year ago. When money sits in a standard savings account, it often yields less than 1%, while the cost of goods rises at a higher rate. Over time, that gap effectively shrinks your savings. To maintain purchasing power, your capital needs to exist in an environment that historical data shows can outpace that erosion. In the stock market, those small daily contributions have the potential to grow into thousands through compounding returns. Relying solely on cash guarantees your money loses value relative to the economy. Moving into the market transitions your savings from a static pile of bills into a growing asset. Two primary obstacles keep most people on the sidelines: the belief that investing requires a large upfront sum, and the fear of seeing their balance drop during a bad week. Attempting to time the market by guessing peaks and valleys is a heavy psychological burden. Most individuals who try to beat the market manually end up selling when prices are low out of fear, or buying when they are high out of a fear of missing out. A systematic investment plan, or SIP, bypasses these human errors. It operates as a preset rule for your money, executing trades automatically, regardless of the current headlines or your own emotional state. High-level investing requires removing the daily burden of choice. You replace intermittent, emotional decisions with a schedule of consistent, automated actions. The operational logic of the SIP is a fixed capital injection every month. The system buys in whether the index is high or low. At a market peak, a fixed $100 contribution acquires fewer units. During a dip, that same $100 automatically acquires a higher volume. This is dollar cost averaging. When the market recovers, your aggregated units are worth more, lowering your average cost. This mechanic completely changes how you perceive a market crash. Instead of a threat, volatility becomes the source of affordable shares for your portfolio. Setting up takes just 10 minutes. Choose a regulated U.S. brokerage firm, like Fidelity, Vanguard, or Schwab. Link your identification and bank details. For the core portfolio, choose an S&P 500 index fund. It tracks the 500 largest U.S. companies, providing instant economic diversification. You then set the parameters. Choose an amount as low as $10 or $25 and schedule it right after your paycheck. Once confirmed, the most important step is to stop checking. Let the schedule handle the execution while you focus on your actual career. This 10-minute setup replaces the need for a lifetime of active trading. It creates a quiet system that grows your net worth while you sleep. You can increase the output of this system by using a step-up strategy. This involves increasing your monthly contribution annually as your income increases. This chart compares a static $100 a month to a plan adding $50 annually. Compound interest scales aggressively as the principal grows. By year 10, the step-up portfolio reaches 2 to 3 times higher than the static plan. Small automatic increases allow your investments to keep pace with your career growth. It maximizes the efficiency of the capital you are already earning. The success of this approach depends on 3 rules. Start as early as possible, maintain consistency through market dips, and remain patient for a decade. This strategy is quieter and more deliberate than the high-stakes trading often shown in the media. It relies on time and consistency rather than luck or timing. You can begin this process today. The size of the first contribution is less important than the act of establishing the automation itself. Wealth is the result of a well-executed plan. By automating your contributions and remaining consistent, you turn long-term financial growth into a predictable outcome.